We are live. I think Jack tells me that sometimes there's an ad that plays at the start of these podcasts. So if I just talk for a few seconds and then we can welcome everyone back to Punch Card Investing. Unfortunately, Jack's out today as well as Brad and Karan, but Jack's the key man that usually hosts these episodes. So unfortunately, he's stuck with me for this one. But we've got Jason in the house and we've got the return of the almighty Frank Tabor. I think people will be happy to see you, Frank. So welcome back.
It's good to be back.
And today we're talking RVs. I know I am pretty sure I'm the only one in sort of the Punch Card crew that has any sort of investment in this area. But Jason, I know you've been doing a bit of digging on the RV industry this week. And we're going to kind of chat through some thoughts on that initially. So throw any questions in the comments if you've got any questions on RVs or any other topics. I don't think this is going to fill up the full hour or so episode. So if there's any other topics you want us to cover or any other questions you have, throw them in the chat as well. But Jason, do you want to tell us about some of your initial digging in the thrilling industry that is RVs?
Well, it's funny you say the word thrilling there because, and this might be the answer to why some of these companies are cheap. But my first thought I want to share, or just inclination, or just my gut feel when I start digging into these companies, it is so boring. They're so boring. I don't know if it's I'm not a good fit for the industry. I'm not really into the outdoors or anything like that. So I would never, ever be a customer of these businesses. But that said, they seem to be strong businesses for being very cheap. But there's something about the industry that just bores me. Do you guys think that's more of a personal thing just because I'm not a good fit for the industry, or do you think there's something low key about this recreational vehicle outdoors industry? Do you guys have that same feeling?
What do you think, Frank?
I don't know. I think it's boring in the sense that they're very simple, capital intensive type cyclical businesses. Mm-hmm. So it's kind of in the field of, I guess, maybe banks or even some commodity type businesses where it's not an overly exciting industry. It's not tech. It's not super high growth. It's mostly this low growth capital allocation story that's important in these businesses. So, a little bit boring. I would probably enjoy the actual, as a consumer. I'm not yet a consumer of any RV, but probably in the future I will be. So I think the outdoors lifestyle is maybe a little bit more exciting to me than Jason.
Yeah. Tom, what about you? Is this an industry you would be a customer of, or are you just looking at it from a business perspective?
I definitely enjoy the outdoors. I don't know that I'd be a customer, at least right now. I don't know. One of the interesting things with RVs, and I think one of the tailwinds for growth, is that real estate prices have gone up a lot. That might sound like a weird thing to say, but I think a lot of the days of people having good careers and then buying like a second home on the beach and that sort of thing is a more and more distant pipe dream. So I think that's kind of a tailwind for RVs. So maybe if I ever want to go on a big annual road trip or something, I'll become a customer one day. But I definitely enjoy the outdoors. Many people will know about my passion for fishing, so I won't go on about that.
Maybe you could get a pontoon boat from Winnebago Industries, which maybe we'll talk about later.
Yeah, maybe we'll I mean, the company that I know the most about is THO. There's sort of two main public companies that sell RVs listed in the States. There's THO and Winnebago. THO is much larger than Winnebago, and then sort of the third player with a bit of scale really is Forest River, which is owned by Berkshire. So there's sort of the three big players. Which ones have you been digging into so far, Jason?
I've been digging into THO, Winnebago, and I think it's fair to bring up Camping World as well, which is, as I understand it, is a company that sells these kinds of vehicles, and it's a dealership and then charges for services and stuff like that. First thing that I wrote down for THO and Winnebago, I actually did look at their presentations. I dug through one of their 10Ks, the THO 10K, and I found a hidden gem, which maybe we'll talk about, but I texted it to you, Tom, trying to impress you. Maybe I did, maybe I didn't.
That's some good digging. I
Yeah.
was impressed. I was telling Frank before you jumped on here that you were telling me all about these assets that Thor owned, which I had never appreciated as much as I maybe should have. So
Yeah. So the way I kind of broke it down was between those two companies, and then I will maybe talk about Camping World later. It's interesting to hear you talk about these two companies in Forest River, because one of my questions was like, are there any other public companies that like make and sell RVs, or is this kind of it for like the public company space?
this is kind of it. I'll see if I can share my screen here. So I've got one of the Thor investor presentations, and there's always a slide in here that kind of breaks down market share. So if that's coming through, and you can see that's kind of what the big players look like at the moment. So Thor is definitely the dominant player. They have sort of rolled up a lot of different RV brands dating right back to the 80s, basically. They're about, depending on whether we're talking about towables or motorized, they're a big chunk of the industry. Winnebago in red, you've got Forest River in blue there. So they're really the big players.
So this will be a very important slide to look at because you see that little sliver of red on the towables for Winnebago. That's something that intrigues me about Winnebago. Pretty small market share on the towables. But the first thing I wrote down was cloning. So with Thor, I'm cloning you when I look into it. Respect you as an investor.
There's
I went
better
very
people to
deep.
clone than me, but thanks.
Tom, the reason I like you, no, I'm kidding. I watched your interview today with Guy Spirit. It was great. But I do clone you, Tom. You're a great investor, and I like the way you really are a business owner when you own a company. So I'm intrigued that you own Thor. And then with what put me over the edge to actually dig into this very exciting industry was seeing that Norbert Liu bought Winnebago, or bought more Winnebago in the first quarter. And I've heard you guys talk about him on the show. That's when I had heard about him, and I actually went back and read some stuff on him. Very impressed. And he's got a sizable position in Winnebago. So that got me into it. So how did Norbert Liu get into Winnebago? We won't know. But Tom, how did you get into Thor? I've always kind of been curious about.
Yeah, there's sort of layers of cloning going on here, because I first heard about Thor from Hamish Hodder, who has a YouTube channel as well. He was sort of the first one that introduced me to Thor. He was making videos on it a few years back, and sounded like an interesting company with a very long track record of growth. The management seemed to be somewhat intelligent when it came to capital allocation, and the founder still had a big kind of ownership stake. So that's what got me interested, did some digging, and came to similar conclusions. So I've owned Thor since I think late 2018 now. It's been one it's been in the portfolio for some time, and it's been a very volatile ride. I think my initial purchase of Thor was in the 60s. I've held it as low as the 30s and as high as 150, and I think it's something like 75 at the moment. So,
and insiders are buying at Thor.
Insiders have bought recently at higher prices than today, probably in the $90 to $100 per share range.
Okay, so that's what got me interested. I want to know what you guys I want to run the price by you. These companies seem really cheap. The price stocks change from the stuff I'm looking at from a couple weeks ago, but I think essentially we're looking at maybe I'm just looking at it now, maybe essentially of like PEs of 4 to 6 right now, and then maybe what they're expected to earn in a few years. Like Winnebago's might be selling for a PE of 4 on those earnings just a few years out, or maybe even slightly less than that. So this is something I've kind of struggled with. They seem really cheap. It looks like you can effectively get like an earnings yield of like 15 to 18% when maybe inflation is like 8 to 9%, and bonds are just like government bonds are like 2%. So it's like a pretty good earnings yield return. But what are your guys' impressions when you see PEs of 4 and 5s? Do you start thinking like, oh, well, the earnings aren't going to last, that's obvious, and they're not going to be PEs of 4 and 5s? Or do you think I'm going to scoop these up because I want that 18, 16% yield? So how does that 4 to 5 PE, what does that strike you? What does that make you think?
What do you think, Frank?
Well, I think the main thing and the reason they're kind of cheap at the moment, maybe I'm wrong here, it's not something I've dug into too much, is because of rising interest rates and the fact that not many people, if you buy an RV, you're taking on debt. So maybe less people will be likely to take on debt moving forward, which I guess is somewhat part of the reason why it's a cyclical business as well. So maybe that 5 times earnings is somewhat justified. It depends how, I guess, your long-term outlook is on the market and how many people will be willing to take on debt to buy an RV. There are lots of both tailwinds and headwinds that I could kind of think of to the industry, but I think it's probably rightfully cheap, but it is at that period. I guess if you look back over the past 20 years at their kind of PE ratio or price to book even, it's at the very bottom. It's almost as cheap as it's ever been in the past 20 years. So if you think maybe 10 years out from now that the story changes, which is somewhat hard to predict. I don't know how long that takes, but probably very long term, I could see them still being a dominant business. So now's the time to be looking at least.
Tom, are these the kind of businesses that will just flat go broke if there's a bad recession and people aren't using as much like discretionary income to buy this pretty large expense in their life that they don't need, and they just go broke during bad times? Or like, have these companies been around for a long time and they can get through a down cycle?
Yeah, that's a good question. It actually leads in quite nicely to some data I've just pulled up. So I'm sharing my screen again. Basically, this just, are you seeing ticker now, hopefully?
Yeah.
This is showing, so the revenue in blue, gross profit in black, and then they are a low margin business. So the slither of green you're seeing here is net income. So you'll see they've had a reasonably steady track record of growth, although there's been some lumpiness. And I guess to your question, Jason, the kind of bottom of the financial crisis, they were still just barely profitable. But
which is, I mean, credit to them. That's like, I saw that as well. And that's the first thing I thought was, let me go back to 2008, 2009. And I think Thor made money, and Winnebago, it looks like it made money. Or maybe 1 year they had one loss year, but still, I mean, a real business can handle a loss year or two and still stay in business and grow. So I was impressed by that.
Yeah. So they're definitely cyclical, but they seem to be able to handle it. I guess on the valuation side of things, I went through and jotted down some different kind of earnings, and you mentioned price to book multiple earlier, Frank, just to kind of compare where things are at with historical averages. So if you want to look on an enterprise value to EBIT basis, which is like Toby Carlisle's acquirers multiple, currently trading at 4.9 versus 12.2 is the historical average. PE 4.5 versus 8.9 is the, and when I say historical average, I'm talking back to 2006, by the way. So PE 4.5 versus 8.9. I think a lot of people will argue that that's because Thor had this huge year of earnings last year, which they did. I think they even grew revenue something like 40 or 50% last year. There was this huge boom in 2020. So that low sort of earnings multiple kind of implies that people think those earnings are going to come back to earth. So maybe the multiple's higher on sort of a forward-looking basis. I think the other way that you can look at Thor is you can look on a price-to-book basis. So the current price to book is about 1.27. Again, the average since 2006 is basically double that, about 2.6 is kind of the average price to book ratio. And again, if you want to try and normalize things a little bit, 10-year average return on equity is about 19%. So if you take that slight premium to book value and a return on equity on average of 19%, there'll be some lumpiness in that, but that's where they've come out the last decade. That implies about a 15% return at kind of current valuation. So that's kind of where I'm at with it.
So when you talked with Guy Spear, what was that? Do you recall that term he used about where a business is going or where it ends up?
Yeah, when he was talking about one night stands and all that.
Right, right.
Yeah. Destination analysis.
Destination analysis. So that's something I've kind of been doing on my own. When I started just recently, I've been starting to think about like, well, why am I buying something? What is this going to do for me? Is this something that could change my life and go up like 100 times, like a great business like Carvana? Any takers? No. Or is this something that's going to like, okay, great, like it's going to double in a few years and a 5% position doubled and whatever. So when I think about it, I'm like, okay, maybe these businesses are like, obviously the real businesses, they're good businesses, they're growing. Maybe they should be selling for like a PE of 10. Maybe that's a lot more reasonable than a PE of 5. And so I think like one scenario, one destination could be like, okay, people are wrong about the recession, or they're wrong about these companies having a pandemic boom and then not going to continue growing. And because of that, we go from a PE of 5 eventually to a PE of 10, and I double. But another destination analysis, I don't know how accurate this is, but something I'm thinking is like, it seems to be that these businesses are very acquisition heavy. And it seems to be like there's a lot of small companies in this industry maybe left. And the stronger companies like Thor and Winnebago during a downturn can use that point in the market to scoop up a bunch of acquisitions at very favorable prices, continue to grow. Earnings will grow just like they did in the past. And not only will the stock price go up twice because the PE will go from 5 to a more normal 10, but it'll go up even more than that because the earnings will go up. And if the price to earnings goes up and the earnings go up, that's kind of how you can get a multi-bagger. So those two outcomes, Tom, do you think either of those are more valid? Do you think my kind of rosier scenario is valid, that they're going to acquire a bunch of companies as they go on and continue to do that and actually grow earnings and not just double the PE?
Yeah, I mean, that's been the history of Thor. You'd have to say that now that they're at like 40% market share, that the runway for acquisitions is a lot less than it used to be. But I don't think they're at the end of the runway. The other thing to keep in mind is that Thor have traditionally acquired RV and towable brands. So if you go on Thor's website, they've got quite a nice timeline, and you can kind of work through the history of when they acquired which brands. But one of the things they've started to do in the last couple of years is acquire parts businesses as well. So that's potentially another aspect where they can deploy some capital into acquisitions. And it's kind of interesting. I know from the Fiat Chrysler days, Jason, that parts businesses often aren't that good. But it seems like for a lot of those companies, Thor are almost the sole customer. So it seems to be like a very nice fit, and they have a reasonable level of control over the business. So,
and that could help their margins if they bought them.
Potentially, yeah. I guess it depends on the price and whether they get a good return on that, but certainly could. The other thing that Thor are doing at the moment is they have about a $250 million buyback authorized, and the management have openly come out and said that they think probably one of the more attractive acquisitions they can do at the moment is their own stock. So that's something that they might do a lot more of moving forward. So they authorized 250 million. When they reported in March, they still had 191 million left in that sort of repurchase that they'd authorized. So on my maths, at current share prices, that's a little under 5% of the shares outstanding they could potentially repurchase as well.
So what are you looking to do with the stock? Are you like thinking it's going to go up 5 to 10 times? Or are you thinking more of like, hey, it's going to go up over time, probably better than the market from this price, and maybe more focused on downside?
Yeah, I think the latter. Thor's not going to be a 10x unless you can hold it for a very long time, or you get it exceptionally cheap. But I think it can offer, and again, do your own work on this. This is just my view, but I think it conservatively can offer double-digit returns with definitely some bumpiness, but I think the wipeout risk is very low, personally.
What do you think about the like how fast do you think they can grow organically? Because I think acquisitions rise. In the past, it was a fragmented industry, but now it's very consolidated. So even if they do start to acquire kind of parts businesses, I think the growth from acquisitions is much lower than it was in the past.
Yeah.
So I'd be curious to think how much you think that organic growth can be. And then I guess you could add on that buyback. And I think that's the more realistic growth number that you might see on a business like this.
Yep. Let me just...
Or even in the past, like the rough split between what was inorganic versus organic growth?
Sure. Let me just bring up something I prepared earlier. So this is what the basically RV industry growth has been like over the past, what dates have we got here? Back to 1990. So 5-year CAGRs, I would say, are a little higher than they have been historically, but 6 to 7% is what the last 5 years have done in North America.
Yeah, okay.
We scroll down, Tom, and look at motorized versus towable.
Yep. Yeah. So towable's growing a lot faster.
Yeah. And Winnebago pretty much are only motorized, is that right? Or mostly motorized? And it's kind of opposite with Thor?
Yeah, as I understand it, and we looked at those market share numbers earlier. So mostly towables. Winnebago actually have like a boats business as well, which is interesting. Whereas Thor.
I sent you a link to Winnebago's presentation. I'm not sure if you're able to pull it up.
Yeah.
And they kind of break down their towable versus motorhome versus pontoon.
Mm-hmm. How far down?
Keep going a little bit. Right here. So you can see their towables. I think the gold is just second quarter. These are just quarterly numbers. And just so everyone knows, I'm going to just look up the market cap of Winnebago. According to Google, it's 1.57 billion. So 1.57 billion, 1.5 billion, and in a quarter, second quarter of fiscal year 2022, you can see towables 646 million, and then if you scroll down, 400 million from motorhome, so it's smaller, and then their smallest, it should be their boats. I guess they break it down later.
Okay. So
Tom, if you can go up to, I want to show you guys something that's kind of piquing my interest here. If you can go up to the stuff we were just looking at for Winnebago, okay, and then also if you can flip over to Thor at some point as well. What I want to look at is take a look at this. This is from motorhome, but go up to towable. And this is Winnebago now. And look at that towable. Growth in the towable revenue. And look at the EBITDA. Okay, they make money from it, whatever. They have a margin and all that. But it's growing. And it's their larger segment of their business. It's larger than the motorhome. Now flip over to Thor and show the market share thing where it showed like Winnebago's market share of towable. And this is what intrigues me. I will not be buying Thor as much as I idolize and looked up to Tom. I just I don't want it compared to what I have. But I am open to Winnebago for this reason. So remember, Winnebago, their biggest section of their business is towables. And then look at the 2021 towable market share for Winnebago, 1.5%. And that is what intrigues me about Winnebago, because I could see it seems like there could be a huge runway of growth here if they can take that 1.5% and do something like Thor did, even if they don't get to 40% market share. If they get to 20% and it goes up by 12 times or whatever that is, or 8 times, that's still like a lot more growth than I was foreseeing for like Thor, or at least catching my eye looking at the industry for the first time. Tom, is that valid? What do you think about that? And if you want to flip back to Winnebago at some point, they show their market share growth.
Yeah, I just saw that earlier.
They show it on the very first page, and then they show it a little lower.
Hang on, I'll pull that up. But yeah, I think they're valid points. If you look at how Thor and Winnebago have traded over the last decade, I think Winnebago has slightly outperformed Thor. I'd have to check that exactly. Where are we?
So I'm looking at Winnebago, just to pull out a random year. 2018 revenue, $2 billion. 2022 expected revenue, $4.7 billion. And then Thor, 2018, $8 billion. And then, they doubled their revenue, around $16 billion.
Yeah.
I think part of the issue with growth from for towables, even though they're at the 1.5% or that tiny market share, there is only, I think it's at 9.5% left to the market that is possibly fragmented. That's the other section. So there is limited growth to be had there. And I guess some of that, assuming the industry continues to be consolidated, which might be hard at this point, maybe that 9% isn't something that can be acquired. But I think it's hard to say there's going to be a lot of growth, because Thor's going to take some, Forest Industries, whatever it's called, is going to try to take some too. So I think there's limited opportunity there. Not to say they can't grow there.
So that's a really good point. And I love talking investing with you, Frank, because you find angles like this. That is a great point, that it's not like they can't just, I guess, maybe do what Thor had done for the last few decades. They can't just go out and buy a bunch of businesses, because there's Thor, there's Forest River, there's Grand Design, whatever that is, and then about 10% is smaller stuff. So that's a great point. Counter argument would be, I asked my wife before the show starts tonight, I go, Thor, Winnebago, RVs, what do you know about it? I'm about to go on the internet and talk about it. And she goes, well, I've never heard of Thor, because I know they sell other brands, but she had heard of Winnebago. And I had heard of Winnebago beforehand. And I know this isn't even an industry I think about. So there might be something to them earning market share, not just buying it, but like taking it with a differentiated product that people want. I know that's how they kind of present themselves in their investor relations to their potential investors. Like, we offer something unique. Tom, can you speak to that? Is there some kind of cachet with the Winnebago brand? Are they the premium brand? Could they grow and take market share, not just buy it?
Yeah, I think, Thor's not the customer-facing brand. They're like, it'd be like saying, hey, I'm going to talk about insurance. Have you heard of Berkshire Hathaway? And you'd say, no, but I've heard of Geico, type of thing,
Right.
The customer-facing brands are like Airstream. Like, I think most people have probably heard of Airstream and Jayco and Swift, and they acquired
all the good ones.
Irwin and Heimer, and So I think that's the obvious counter argument to that one. I think Frank makes a good point about acquisition. I haven't bought Winnebago before, but I must say, when I look at Winnebago versus Thor, it's not easy for me. It's not easy for me to tell which one would clearly have better returns moving forward. I think they're very similar.
Winnebago.
The reason I like
Thor, and it's smaller.
The reason I like Thor, I was going to say, was actually quite management focused. That's a big reason I like Thor, is that the owner's still there. And I'm not sure if you stumbled across this, but Norbert Liu actually wrote quite an angry letter to Winnebago management in early 2020 about the amount of debt they were using.
Wow.
So that's probably worth pulling up at some point.
I had not seen that. I did look at the debt. I mean, both businesses struck me as like, okay, this isn't a ton of debt. Like for both of them right now, their annual interest expense versus their earnings or their operating earnings to pay for that interest, it's like really, really covered. I will say I do recall looking at like the $500 million of debt for Winnebago roughly and the $2 billion for Thor. And I remember thinking at first like, oh, that's more debt for Thor. But then when I broke down like the actual debt versus the earnings, it seemed to be that Thor was in a better position with debt than Winnebago.
Mm-hmm. Yeah, I'd have to check that exactly, but it's probably worth noting when you do look at the debt for Thor, a lot of it is to do with their Erwin Group acquisition, which is like a bunch of European RV brands. So they've got those nice European interest rates of like 2% on a lot of that debt. So the interest payments probably don't look that significant. And yeah, we've got a comment here from Hodo Prime about Thor being debt free. So they do have a history of paying down debt fairly aggressively. And I believe through the financial crisis, when they were still making money, they had literally zero debt. So that definitely helped.
And I think that's another problem with even trying to rely on acquisitions for either company within the industry is they do rely on debt to fund their acquisitions for the most part, which moving forward, I think they'd be less inclined to do with interest rates on debt and everything being higher. I would say the debt they have now is probably on a much lower interest rate, but moving forward, I think, again, with the consolidated industry and interest rates the way they are, I don't think acquisitions will be part of either company's story too much.
Yeah, it's interesting. Like the way I look at it is I don't know exactly where the capital is going to be deployed. I hope that more of it goes towards things like share buybacks over time and it becomes like a NVR 2.0 or something would be quite nice. But the way I look at it is the earnings yield, like you say, Jason, is very high, even if you normalize it. And yeah, if that gets deployed into acquisitions, that'd be great. That's kind of what they've done in the past. But if that gets deployed purely towards share repurchases, that would do equally wonderful things, I would say.
So I guess like upside downside, like with Winnebago, they have expanded into pontoon boats and other areas of the outdoor recreational lifestyle. So I guess the upside case for like if you have to choose between these two companies would be that the Winnebago might have some more debt, but they have that small market share on towables, and then they are showing that they are going to diversify into other areas of this industry, which means you never know what the next acquisition could be, and they might have like a larger growth story aspect to their business. But I guess the upside for Thor would be not only like the capital allocation you're talking about with the buybacks and the aversion to debt usually that they have and the low interest rate on their current debt, but I found on their 10K, they own like 20 million square feet of industrial space. They own it. They don't lease it. They own it. They lease some, but they own 20 million square feet roughly. And what like bringing the whole Seritage discussion once again, and how's that going, everybody? I got out a few months ago. Oh, same story. Okay. But I don't know like what that sells for per foot or the cap rate or all that kind of stuff. But like just a brief glance at like what buildings are selling for in Indiana, where a lot of their real estate is. It seems to be like they've got a lot of margin of safety protection or downside protection, if you will. Like it can't be a bad thing to have 20 million square feet that you own. So when I told you that, Tom, and I had found that, did you think like, oh, what a relief? Or did you just think like, good, but it's not a game changer?
Yeah, I was surprised I hadn't really taken much notice of that before. But I think the latter, I don't know that it's a game changer, but
what's the value of the land on the property on the books?
Yeah, Jason and I were texting back and forth about this the other day. I'm just looking at WhatsApp. So I had,
yeah, me too.
I came up with 975 million.
And that's what they have in the books. And is that an old price? Is that updated with the inflating?
That takes out the accumulated depreciation. So
yeah,
they list out their PPE and like land is 142 million, buildings and improvements almost like 800 million, machinery and equipment 500 million, and then they have some depreciation against it. So no, Frank, I don't think there's anything out there that would like tell us like this is what the land is worth today. It could be out there, but I didn't see anything like that. And I think a lot of the land is in like northern Indiana, so I'm not sure how valuable it is or not. And some European land.
I'd be curious to know if they are kind of having that revalued as they move through time, or whether that's sat there for 5 or 10 years at the same price. If it's sat on the books for the past 10 years at the same price, then that is probably an appealing aspect of the business.
Yeah, it was just like this little hidden gem I found, like, just a little bonus. But yeah, I just get back to like, I don't know. It's hard. I have trouble getting excited about these two businesses compared to things like Carvana or Races or Google. But at the same time, I could see myself being here like 3 years or 4 years from now, and maybe the market's gone up like 20% from where it is today, and these businesses are up 100%, and that's pretty good. Tom, are you?
Tom,
Yeah.
I was going to ask Tom, how are you thinking about the current market environment with interest rates rising, and I guess even things like fuel prices could just be another
price of oil.
Tailwind.
Yeah.
There's a lot like this is why the share price is dropping, assumedly, without me knowing too much. How are you thinking about that over the next 5 years, or are you just looking past that?
Yeah, I think it's a it's a cyclical business, and it'll continue to go through cycles. And these are you're laying out some of the things that drive that. I was just trying to pull it up actually, but here we go. So Thor actually did a press release the other day. They did. Actually, I'd have to remind myself whether they did it or whether it was a third party, but it was to do with the impact of rising fuel prices on RV purchases. And I was kind of blown away at how little of an impact it seemed to have from kind of the customer surveys and things we were doing. Time will tell how true that is, but that has an impact potentially. I mean, we are dealing with fairly affluent customers, I would say. These people that are purchasing RVs, and I think relative to buying a holiday home or something, it's probably still a cheaper option in a lot of cases. And then interest rates do have an impact. I mean, like you say, people are often financing these things, and impacts the interest payments and things for those loans.
Do Thor have their own finance branch or not? This is me not knowing anything. Do they finance any of them themselves?
Yeah, we saw a question on that before. I don't believe so. So Thor's a wholesaler. I would think those loans sit with the dealers that are selling it to the end customer.
True. Yeah.
Tom, is there any interest from like companies outside this industry to want to get in this industry? Like this probably would never happen, but like a General Motors or like an auto company diversifying into another area like this. One thing I always think about, like destination analysis, like with Carvana, I could see a day where Amazon goes, we don't sell cars we want to buy it. Or a huge established dealership chain goes, we want to catch up on online and buy it. And I kind of like having that as kind of like a somewhat of a safety net, or just a way out eventually. Is there anything like that? Or do you think this industry, it just seems so like off on its own?
Yeah, I think it is kind of off on its own to an extent. I guess the industry is small enough to where if someone wanted to do an acquisition, like a Berkshire wanted to buy Thor or something, I think that's probably what might happen. I don't know that an auto company would come in and try and kind of shake up the industry personally. Yeah, could be wrong on that. I mean, auto companies do have some exposure to this industry. Like Thor don't, build chassis and engines and things. They use, they use kind of chassis from Mercedes, for example, to build a lot of the RVs that they sell. So the automakers do have some exposure to the industry already through that. Super chat. Got a super chat from Josh. Thank you very much. Quick take on Westrock Coffee going public with RVAG S4 on investor page, westrockcoffee.com, page 159. No, they acquired S&D for $405 million in 2020. Do you guys have any idea what that's about?
Zero.
I've never heard
Do
of
you
that
want to pull
company.
up that page and see what it is?
Okay.
You did give us $5. I feel obliged.
Yeah.
I wonder if their baristas are trying to unionize as well over at West Rock Coffee.
So is he saying they're going public? They're not public yet. So we're going to have limited information on them.
I'm not sure. I can't get westrockcoffee.com to work.
Maybe we skip it for now and I'll have a look to see what I can find.
Okay, let us know what you find, Josh. You might have to clarify what you're asking there. Yeah, I think the threat of someone else coming in is low, though, personally, Jason.
Gotcha.
Yeah. I mean, in many ways, these things, I think I've said this on previous streams, but in many ways, they are like homes on wheels. I guess that's in the name, motorhome. But that's where I would say the THO subsidiaries are adding most of the value, is kind of fitting out the furnishing of the vehicle rather than actually designing the body or anything.
I think the reason why both of these companies are going in my too hard pile is destination analysis. Like, I see a low PE, I see a couple businesses that look like they're well run and good positions in their industries and all that kind of stuff. But I don't know where it's going. I don't know how much of this pandemic boom and interest in the outdoor lifestyle is sticky. And I don't know like what this business is going to look like in 5 or 10 years, like at all. And that's just my limitation on my knowledge of the industry. But that end game, that destination analysis it just keeps me out of it. And if they were like a PE of 2 or something like that, or had some huge thing on their balance sheet that was like worth way more than the price of the business, I would get interested. But I think that's where I'm at now, is I see a couple cheap businesses and they're cheap, and I just don't know where they're going. So that's kind of where I'm at right now.
Yeah, that's fair. I think my view on that is you get maybe slightly higher than inflation organic growth. You have a company that prints a lot of cash and it seems to be getting allocated reasonably well and has done for a long time. So I think the destination is you have a larger business in a decade from now, a little bit of organic growth, maybe a little bit acquisition. It's not going to be 10 times the size of what it is today, and you probably have fewer shares outstanding. So that's sort of the way I look at it.
I think if I was like really freaking rich, I would be interested in this business because it'd be a place to park money. I don't think I would be too worried about that money going away. And then between the buybacks and the dividends and the regular growth and acquisitions, I would be like, okay, I'm going to get a decent return on a big pile of money here. And a decent return on a big pile of money is like really good for your life and all that. So, but I'm more at the stage where I'm trying to like get that 10 bagger, get that or more 50, 100 bagger with a very, very limited downside. So I think that's why I've kind of, after doing it in a deep dive, I was kind of like, I'm going to dive out.
Fair enough.
Yeah.
I did just really quickly skim through the investor presentation for Westrock. So they're going through a SPAC and they're becoming public. It'll be under the ticker West, from what I've read. It was a $1.1 billion deal. I think they make around $700 million in revenue. But that's as far as I know. I think to actually give a good opinion, there'd be a lot of digging to do on that. Anything that's going public through a SPAC requires a lot of research, or any newly listed company for that matter. I don't think it really makes a difference whether it's a SPAC or just going public. It's hard to form an opinion without that history of financials.
Yeah, fair.
What do you guys know about Camping World?
Very little, actually. What have you found out?
Well, I think the CEO, Marcus Lemonis, is the guy who hosted this TV show about small businesses. And that's where I first saw him. People, Products, and Process was what he was always preaching. I can't remember the name of the show right now. But there's some interesting things going on there. He does a lot of insider buying at the company. Some other people, a couple other people are doing some insider buying at the company. And then near Mount Rushmore, on the path to Mount Rushmore for my Mount Rushmore cloning, I have David Abrams there, and he owns Camping World, and it's like a 3 to 4% position of his 13F, which means it's probably more like a 1.5-2% position. But I think it's because it's down. He first bought it in Q3 2018, and the stock price then was maybe around $20. It's at $25 now, and they seem to be an RV dealership. I know we have one where I'm at. I've driven by it, and there just seems to be possibly more of a growth story there. It doesn't look like they do presentations, but I look at some of their press releases. It says Camping World to expand national footprint in 11 major markets by end of 2022. Camping World announces largest dealership acquisition in company history. And I think their dividend is like almost 9% right now. And it just has been at like a PE of like 4 for a while now. So it's something I've been wanting to dig into more, and kind of getting exposed to it yet again, adjacent to the Thor and Winnebago, kind of piqued my interest again.
I like the idea of taking kind of the people selling these things. Like, I know the company that keeps getting brought up in the comments by someone is One Water Marine, which is, I guess, the equivalent in the marine industry. They're selling boats instead. And that's a very fragmented industry. They grow a lot through acquisitions, which is really appealing. I don't know whether or not that's the same within this kind of RV space. And being Australian, I don't even know what else Camping World does. I'm sure it's a lot more than just selling RVs, whatever portion of their revenue that be.
Maintenance and ancillary services.
Yeah, so I guess maybe that's more of a fragmented industry where there could be more growth opportunities. But I just had a quick skim through their financials, and it's pretty painful to look at. Just
Why is
very
that?
cyclical. If you just look at their cash from operations or something like that, there's a few negative years in there. It's up and down. There's a lot of dilution, as much as 100% over that in some years, just in the past 5 years. So, yeah, it would be one you'd have to understand very well and what they're trying to do, because it's not that typical, easy to understand business from what I can see at a quick glance.
Yeah, it looks like an analysis here says that management is actively buying more dealerships. So that seems to be their strategy, which I guess it could work out well if there's sustained demand for these RVs. But maybe if there's a drop in the industry, they might have a problem with their debt. So
They could get acquired by Carvana if they want to branch into RVs.
I did think about that, how one day it's not about acquiring a company like that. It's about just adding on RVs onto our wonderful business and then overtaking people. If it's got wheels, we'll deliver it to your house.
There you go. Can I get it? So can I get it like a new lawnmower from Carvana?
Not yet. But
Or an office chair?
The march continues, Tom. The march continues.
Okay. We got a super chat. Let's go. James asks, which will be bigger in 10 years, KPG, Thor, or Carvana? Who wants to have a crack at that?
If the answer's bigger, Kelly Partners Group will be the smallest. If we're talking returns, then there's a different argument to be made there that I'll leave unsaid on that one. We've got a couple of comments already. But by sheer size, Kelly Partners Group will definitely be the smallest.
I agree with. Well, I don't know. In 10 years, I'd rather be. I think if I'm looking for growth and safety, I'm looking at Kelly Partners. If I'm looking for growth, I'm looking at Carvana, and if I'm looking for safety, I'm looking at Thor or Kelly Partners.
Yeah, I think I don't know. Carvana's just too hard for me personally.
It's
I
not
don't know
hard, Tom. I
where that will
mean,
be in
weren't
10
you
years.
listening last week? Weren't we on together?
I was
It's not
listening
hard.
intently.
Yeah,
Yeah.
good.
I
It's
didn't
very.
even listen to last week, but I think Carvana's another
You
story
just
where
saw the title and ignored that one.
But I think Carvana's another story where it's built for a different interest rate environment. In a low interest rate environment, I could see the Carvana story working a lot better than I can right now. But that's making a macro call that I'm not comfortable with either way. I think Thor suffers from that slightly as well. Every company does to a certain extent. I think Kelly Partners is a little bit more built to be fine in that type of environment, but that's a clear bias I have out of the three companies.
Yeah. Yeah. I think KPG is probably the highest quality business on there. It's the price that holds me back from having a clear answer on that question. And at Carvana, it's just hard for me to assess. Maybe that's the best quality business. Maybe it's the worst. I don't know.
Yeah.
Carvana has
Thank
the
you for
most
the super
potential. We can throw that out there. If Carvana pulls it off, they are by far the best opportunity there. But there's a lot of unknowns in my mind. I think Thor's somewhat predictable. You can probably expect these low teens type returns just through dividends and buybacks and organic growth. Kelly Partners is more of an acquisition story, so there's a little bit of room for it to go wrong, but it is a boring, fragmented industry, so a lot of consolidation to happen. But they're all very different businesses that are hard to compare.
Yeah.
So, Tom,
You guys
what
seen-
about? Oh, go. Well, I'll go
No,
ahead.
you-
What about your Tom? You're smiling, so I'll continue. What about you? What about your position? What about your position sizing for Thor? If you don't mind sharing, was it big, small? Are like the price is down, isn't it? Like, are you jumping to buy more, or
Yeah.
any thoughts on that?
Maths. So right now it's about 7% of my net worth. That's the current sizing.
So a position for ants is what we're saying.
Yeah, I hadn't done anything with Thor since 2018, and I added to it a couple of weeks back.
So you're an active buyer.
I was a couple of weeks back. I have no plans to add more unless if it were to get cut in half or something like it did from here in March 2020. I was too dumb to buy it there for some reason, but if that happened, it would be a bigger position for sure.
Looks like it got down to $35-$40, which,
Yeah,
based on today's price, that's like a PE of 2 or something around there, 2 to 3.
Yeah, on today's earnings, it's probably in the high ones, I think, isn't it? And then it rebounded to as high as 150 or something. It would have been a 5x at one point if you'd bought it then.
Did you have any, like when it goes to 150, next time it does that, like say it does that in 6 months or something, are you going to be more apt to think about selling it based on your experience as an owner so far?
Yeah, it's a good question. I did think pretty seriously about selling it when it was getting north of 130 maybe. I didn't have a whole lot that was interesting at the time and thought it would still offer reasonable returns. So I made the decision to hold it. When I first bought, I thought that intrinsic value was maybe in the $100 to $120 range.
And it got there.
I think you could add $15, $20 a share to that range now, is my personal view. So it definitely got fully valued, maybe even a little expensive, but I just didn't have a better place for the money. And I as I recall it, I already had a reasonable cash allocation, so didn't feel particularly inclined to sell it.
I do appreciate the fact that like you told us about Thor and that I did spend a morning just looking at these two businesses, because if the next time there is a price crash or a drop in the industry, I'll feel more prepared to, or I'll be prepared to make a decision quickly on these companies. And they're good businesses, and now I feel like I know them both, and I can just put them on a watch list somewhere. And if they ever crash, I can dive in knowing them in a good way after just a morning of like looking into them. I'd be curious, Frank, do you kind of look at things like that when you do research on a stock? Do you just kind of, even if you don't like it at that point and you say no, do you kind of just store it there on the shelf and go, maybe I'll just get into this at the right time if that time ever presents itself? Do you have that kind of thinking about research?
I do, but I probably don't do it as well as I should. Sometimes I have a bad habit of watch listing a company that I really like and then not following it whatsoever. So a couple of times there's been companies I've had on a watch list I knew well once upon a time, and then they start to get cheap, but I haven't followed them. So it still requires a lot of research. I think if you're going to kind of just put them, if you're going to be ready to buy, I think you need to be following very, very closely leading up to that event, which is something I don't do well enough, maybe due to the lack of time that I have to do that. But it is a good thing to do.
Yeah, I don't follow them super closely either. Like when something kind of loses my interest, but I do like that it's kind of boom just there. Like I did that with Seritage when the price was 14 or 15 or 13 for a while, and then it dropped to 10. I was able to go back in there quickly. So I do that as well. I'd be curious. Question for you guys. Moving away from as we drive on past the RV discussion. Thoughts
Into
on
the sunset and our Jacos.
or our Airstreams or
Exactly.
the other brands that we're supposed to know so well. General thoughts on like this time in the market. Are you seeing a lot of opportunities? What's on your watch list? I've got a couple names I'm looking at closely, but be curious what you guys have been digging into lately.
I've been refreshing my memory on Kelly Partners, which we've already talked about.
Good choice.
Because it was suddenly down like 15% a day or something randomly last week, but it's almost fully bounced back from that, I think. So I still just can't bring myself to add it. But
why not, Tom? Why do you think it's a pricing? Like, is it a PE thing? Like the PE's high, or?
I
think about it as well.
It's close to 40 times earnings, I think, at the moment.
That's quite expensive right now. I've been feeling like I'm missing out, and I should be looking into them more. But I don't know. Seems a little pricey, but maybe not.
Yeah, I don't know if I've got this weird thing in my head that I don't know if it's rational or not. But Kelly Partners is acquiring businesses for what, like 5 times earnings, Frank, something like that.
4 times EBITDA usually.
Yeah, you could almost call it 2 by the time they make some efficiency gains and improve the margins. And then you're buying a group of all these acquisitions done at those multiples for 40 times. And for some reason, that just doesn't make sense in my head. Although I get the maths, like I get the almost Constellation software type, lots of small acquisitions type model, and I can see how accretive that is to earnings, and I can see that it makes sense. But there's something in my head that just I can't bring myself to pay that much. I don't know if you have thoughts on that, Frank or Jason.
I guess just regarding the acquisitions, I think although you're buying a business that's arguably a crappy business, I guess, like it's 4 times EBITDA business for a reason, they're usually slow growing type businesses. But they become much better once Kelly Partners take over. It goes from around a 19% EBITDA margin to around 33% after, I guess, the synergies. It's a word that Brett Kelly doesn't like to use, but it's kind of how I think of it at least. And you're buying them cheap. So regardless of the multiple of the overall company, there's a fragmented market of cheap businesses that you don't have to overpay for. I think it's not something I'd always recommend, but I wouldn't even mind seeing Kelly Partners Group raise capital to fund some of these acquisitions, which is something like Henry Singleton might have done, take advantage of the public multiple to acquire private businesses, which is what Brett Kelly's doing. But they fund theirs through debt, which I think is fine as well. It's just there's a lot of acquisitions to be made. So whether or not they're these low quality businesses, I guess, they get better, and there's a lot of them to be made, which leads to a lot of growth. And I think it can lead to a lot of growth for a long time as well.
What's the debt situation like? Sorry, Tom.
The debt's definitely complicated, but a lot of the debt is passed off to the part owners in the business. So when they acquire a business, they only take a 51% stake. They leave 49% to either the existing owner or someone within the company, which is almost how they do it every single time. At least there is a few that haven't gone exactly that way, but that's the typical scenario. And a lot of the debt is left with that 49% ownership. So you get a balance sheet where the debt seems to be huge. It looks like they have a lot of debt. That affects some of these kind of EV multiples and things as well. But it's not completely the head company's debt, at least. So it's a complicated structure that not many companies follow, and it leads to a misleading balance sheet, I think, at least.
Yeah, the raising capital thing's interesting because I think they pay out something like 60% of their earnings as a dividend, which sort of
50, 60, yeah.
leads me to suggest they can't do enough acquisitions to spend all the cash. So why would you raise capital? Or am I just not understanding something properly?
Raising capital is something that Brett Kelly, first of all, says he'll never do. It's just something in my mind that I think makes sense, but that's if he doesn't, I trust him for knowing why not to do it. But what were we saying about the dividend? Sorry.
Well, yeah, if they raise capital, it seems like they wouldn't be able to deploy it fast enough if they're having to pay dividends to, I don't know, keep the ROE high or whatever.
That might be the case. I think they don't want to rush the acquisitions. There's a big pool of acquisitions they can make, but I don't think they want to take on the additional risk by doing too many. I forget the exact numbers, but in their investor presentations, they say how many possible opportunities and companies they're talking to at all times, and there's a very large pool. And that's before you even kind of go beyond and go abroad as well. And the dividends is kind of a separate issue where being an Australian company, there's some tax advantages to paying dividends as well. And it's in a market where most investors are attracted to dividend-paying companies. A lot of the money in the Australian stock market comes from retirees with their super funds and things like that, where they're looking for these dividend-paying companies. And Kelly Partners just kind of have that extra amount of earnings to do that. So I think they wisely take advantage of that. Typically, I would like to see a company not paying dividends and fully investing towards acquisitions. But I think if you can do both and it's still leading to great returns, I don't see a problem with that. Yeah.
Do you reinvest those, Frank? Or do you just... Yeah.
I don't reinvest the dividends. No, I kind of just let it pile up into my cash and don't really consider it as part of my return from Kelly Partners Group.
Yeah.
Obviously it is, but yeah.
Yeah. To finish answering your question, Jason, the other thing, another Frank stock that I've been looking at is Hingham's Institute for Savings, which is a small, seems relatively simple bank. Probably another one of these ones that's not going to be a 10x in a couple of years or anything, but could compound at attractive rates for a long time. Do your own work on that one. I'm currently reading a book on banking, which is another thrilling industry, Jason, that you should take a look at to try and get my head around this thing.
What's the book?
The Bank Investor's Handbook. What a title.
Strange industry once you start digging into it.
How so?
Well, just about like their work, the way banks work, like with the Federal Reserve and all that kind of stuff. It's just a very unique industry. We were talking a little bit about Higgins or whatever it's called last week. Frank, thoughts on that company? Are you still following that one?
Should we buy it?
I certainly won't make recommendations. I've owned Hingham's for a while, and it's one I'm following closely still to. I'm building up a lot of cash, so I don't know what to do with it. There's nothing that's jumping out of me as great opportunities, so I'm kind of looking within my portfolio to see. I shouldn't say there's nothing. There's a handful of companies that I am following that are interesting, but nothing that's really that I've wanted to pull the trigger on, I guess. So I'm also looking within my own portfolio, and that's one that stands out as cheap, I guess.
If the cash ever becomes a burden, you're more than welcome to send it my way. What about you, Jason? What have you been looking at?
I'm kind of in the other side of things. I am just like scrounging up every dollar to go buy stuff. Obviously, Carvana, we talked about it last week, but it's down even since then, which I thought has been a great thing. And just to put one piece of news out about Carvana, there's more insider buying at the company. The general counsel, the lawyer at the company, has bought. It went from like 49,000 shares to 93,000 shares. And I think if you do the math on 93,000 times, call it 27 bucks, that's like 2.5 million or something. So it's not like he's one of these guys with like $1 billion and then buys 100 million of Carvana, like the father and son owners did. But it's just what seems to be more of a relatable investor, if you will. So that was a very bullish sign to me. He's made multiple purchases. Google, it's getting sucked down with all the tech stuff, but Google's not like everybody else. So I'm buying Google and waiting to buy Prosus again. It's still low, very low, just in that 30-day period with the tax wash sale situation. I got to say, I've enjoyed being an Alibaba owner again, as I'm using that to park the money for Prosus. Coupang's out there, Floor & Decor, a Berkshire clone. And then the one that's kind of been really that I've been thinking about a lot this week is the stock ticker PARA, Paramount Global. And it's like the Viacom cable channel, CBS cable network combined company that they then rebranded into Paramount to get into the streaming game. And the reason it's on my radar is because someone at Berkshire Hathaway bought like $2.6 billion of it in the first quarter of 2022, a few months ago, based on Ted Weschler's interview that he did, the podcast with Nebraska Furniture Mart, NFM. He talked about reading about streaming and all that kind of stuff. I'm going to say it's at least a Ted Weschler purchase. Maybe it's also Todd Combs, but I'm thinking it's Ted Weschler. The reason why it's piquing my interest is because it was a $2.6 billion position. How much do Ted and Todd own or manage? Probably somewhere around 17 billion. Because I think we've heard the number thrown out recently, like
it's
34.
About 30, I think.
I thought it was 34 billion combined.
Yeah, that sounds about right.
Yeah, so you take that in half, that's 17 billion. 2.6 billion divided by his half, 17. It's like a 15% position. And so he's a great investor. He's on my Mount Rushmore with Warren Buffett as being part of Berkshire Hathaway. So I'm trying to figure it out. I'm trying to get comfortable with it, but I'm also reminding myself to clone relentlessly and shamelessly and maybe just buy it, because I think it's maybe 20% higher than the low during Q1, and I'm comfortable with that kind of range in terms of difference of price. So it seems simple enough. Like they make money from their cable networks and their cable channels, and they're getting into streaming, and they're losing money on that, but it's growing. Had you guys heard of them? Or I know they have Pluto and then like Paramount Plus, CBS, I think, MTV. Any thoughts on that one?
Yeah, definitely heard of a lot of those channels, I guess. A lot of arms of their business, but never looked at the company.
They also have a movie making business that made a record-setting movie, Top Gun Maverick, that came out over Memorial Day weekend. So they're in the news for that as well. But that I just not yet, but I really want to. Favorite actor,
right? I can tell you haven't seen it because it seems like all the people that have watched that movie, or all the guys that have some sort of facial hair that go to watch it, they come back and shave down so that they've just got the moustache left.
Yeah.
So that's how I could tell that you hadn't seen it yet.
Yeah, well, maybe next week I might do that.
Yeah.
But yeah, the stuff I like is still down. Carvana, Prosus, Google. So I've been scooping stuff up. As everyone's nervous.
Is Alibaba just an in-between kind of holding for you, or do you see yourself continuing to hang on to some of that?
It was an in-between holding. Like I sold Prosus because it was way down and I wanted to book a tax loss, and then I just have to wait 30 days till I can get back into it. And so one of the two things I put money in to hold there is Alibaba. The reason why is because I have been watching them trade over time, and it just seemed like if there's good news out of China, the odds are it's likely that if Prosus moved up, Alibaba would move up as well. But then that quarter came out, and I was just really impressed with their resilience as a business and the way they're still able to grow in some areas, and the buybacks are going on. So I've been asking myself, what am I going to do? Like, am I going to move this half, all of it, back into Prosus? I'm not sure yet. I definitely want to own Prosus again. But I've enjoyed being an Alibaba owner, and it does feel cheap and has a long runway and all those kind of things that people like about it.
Yeah. Cool. You guys got any questions you're seeing that you want to take before we wrap this up? Actually, I do have a question. I'll go for it, Frank.
Oh, just really quickly, Matt Hansen said, does anyone know where to get the Focus Compounding shareholder letter? I also would love to come across that. So if anyone has seen that, I'll bring some extra attention to that. Send it through my way on Twitter if you find it, please.
I would just like to throw out to Karan that I miss you. And I'm sad you weren't on tonight.
Yeah, that photo you sent through after last week's episode of your shrine to Karan was quite impressive.
Yeah. Don't share that.
Yeah.
But
sorry.
A lot of rooms in a house. There's a lot of rooms in a house, and if it's one room for him, that's okay. I do want to, if you could bring up this comment by Sandeep, isn't Amazon acquiring Paramount? I don't know. I had not heard that, but the whole idea with Paramount is they went to bankers, and Sherry Redstone's the head of the company in terms of voting control and all that. And they went to bankers, and bankers told them, like, in this era of the streaming wars, basically you need to combine with Peacock, and you need to get bigger to be able to compete. And they said, okay, that's okay. We're going to go do it our own way. And one of the things I like about this possible investment, which it just seems like a no-brainer to me, if Ted Weschler did it, I'm going to probably do it. But one of the things I like about it is that there are other businesses out there with a lot of cash that one day could buy this company because it could fit into their business model. Some of the bigger streamers, whether it's Apple or Amazon or Netflix or someone like that, even though right now they're saying we're going to go it alone, and they chose not to be acquired, and they chose not to acquire anyone else at the time. Things could change over time, and I kind of like that. Again, there's that out that you might get purchased at a higher price because there's buyers out there that make sense.
Yeah, it definitely seems like a company that would be an acquisition target, just given their nature of business. But I think if a company could be an acquisition target, I think that's a nice little additional margin of safety, is how I would think about it slightly.
Yes.
Not always the case, and probably never something you should rely on, but definitely seems like a company that's likely to be acquired, assuming Amazon isn't already acquiring it. That would make sense.
And he commented that he meant he was mistaken with the MGM Studios, the James Bond company.
Jason, the other thing I was going to ask you about was Google, actually.
My Google, my beautiful Google, my 35% position. Yeah.
Well, that's why I want to ask you about it. If I look at the revenue growth for Google over the past few years. We've got 20%, 22%, 23%, 18%, 12%, and then 41%. Is Google just look cheap on a multiple basis because they had a boom year, or is that going to last? Are they going to continue to grow 20% off that base? How do you think about that?
So for reasons I just can't get into, I do think they're going to be able to continue to grow, given their business model and the fact they're in auction and all that kind of stuff. I just think there's a lot of growth there. Just even if they didn't improve the product, even if people didn't come in from social media advertising because they want to do something that actually works and that kind of thing. So I think there's growth there from that, but also, and a lot of that pandemic growth, if you will, that was from more stuff going online, and then those businesses doing more business online, advertising online. I don't think that's going away. I think that all that kind of stuff is here to stick around. But I do something called investing with training wheels. I use Value Line a lot. And Value Line kind of gives their estimates of earnings and sales and all that kind of stuff for the next year, 2023. But they also go out to 2025 to 2027, like 4 to 5 years or 3 to 5 years out. They also do that, like for all the businesses they follow. Doesn't mean they're going to be right about things, but that's something that I don't do as an investor. Like I don't have that skill set I've never had confidence to do one like a DCF model and say, well, I project this company is going to have this growth rate and earnings are going to be this in 5 years and all that kind of stuff. I don't do that, but I do it in a sense with training wheels, which I sometimes rely on Value Line and their estimates. If you look at their estimates, going out a few years, which makes sense to me given what I know about Google and my familiarity with it, it's like a PE of like 12 or maybe 13 on those earnings right now when you back out the cash. So it's like very cheap for the earnings just in a few years. And it's one of those businesses where I'm not just looking to buy it for a few years. It's like I could see myself owning this forever. And I could see it continuing to grow and grow forever. So that's kind of why I'm in it. Not to mention the market share, the lack of competitors, the stickiness of the product, all that kind of stuff.
Mm-hmm. Frank didn't like your Google conversation.
Well, if he wants to talk a little meta.
Camera straight back on. Okay, one last question for you, Jason, while I've got you here.
Yeah.
I want to get you 2 cents on what's going on with oil right now. But do you still have some oil holdings?
Oh man, do I have some oil holdings? Yeah, I'm like a genius. It's just people don't know it yet. So Ring Energy still big holding for me, and Pedevco is like a smaller holding, but I kind of look at it as one. Let me just go to the after dinner investor portfolio. Go to Whale Wisdom. It's a joke. By the way, speaking of jokes and Tom not laughing, last week, Tom, I
was checking the Ring stock price.
I know you check things. There's a delay and tech issues and all that kind of stuff. Last week, I said something like, and yeah, Tom would remember what Fiat Chrysler did in March of 2020 when he was selling. And you didn't laugh, and I was like, oh boy.
I didn't. I don't know if I heard that at all.
I know. I don't think you heard it. So okay. My position in Ring in the after dinner investor portfolio in Pedevco is like 4 plus 11, like 15, 16 out of 73. So large position. Yeah, still a large position. And oil, it just went up again today. And not only that, but natural gas here in the United States has gone from like $2.53 to like $8.50. And that affects a company like Ring because some of their reserves are natural gas. But yes, I'm still involved.
Yeah. And so if you were to assess an oil company today, like are you sort of trying to normalize for lower oil prices? Because I know listening to some of your older podcasts analyzing Ring and Pedevco, you're talking about, this is what the earnings might look like at $50 oil or $70 oil or $100 oil. And and we've got some really high prices at the moment. So how do you think? Through
Yeah,
that
so
now?
they do their present value discount stuff, this PV10 thing that they report for the SEC. So you can kind of compare the reserve value from company to company. That pricing is based on the average price in the year of the reporting, and like the average price in 2021 for their annuals now for 2021 is like around $65 and around like $3 to $4 for gas. And obviously the prices are a lot higher. So I'm not buying more, because to buy more, I think I would have to kind of assume that like these prices are going to stay. And if they're going to stay, then it means like the reserve value is worth a lot more than these companies are selling for. Not saying that, but that would kind of be the mindset. But I'm using it kind of like a downside thing. So where I used to use like, okay, well, I don't think Ring would like go out of business at like $42 or $45 oil. And I don't think oil is going to sit below $45 in the United States over the long term. That was my floor then. Now, maybe it's the wrong thing to do, but I'm kind of looking at $60-ish oil as my floor to kind of justify staying in the businesses, hoping that like, they can just keep, the stock price will keep going up if these oil prices do stay high. So I feel comfortable keeping them if oil was $65, because you look at like Ring's, their PV10, it's like 1.1 or 1.2 billion or 1 billion or something like that at 60 something dollar oil, and you back out like a little under $300 million of debt, and you're sitting at like 700 of value or something like that, or 800 million of value, and like they're selling for 500 million or something like that. So it justifies me staying in it. But I'm not telling myself that these prices are going to stay this way. If they go down to 60-ish, fine. I still feel okay in these companies at that level, given the price of these companies.
Mm-hmm. I like it. Have you ever analyzed anything in oil, Frank, or not?
Not really. I looked at Blackstone Minerals for a little bit there a while back, but no, I've never been overly attracted to the industry for pretty obvious reasons. I think obviously right now it's worked out well if you're investing in oil, and might continue to work out well for a while, but there's no kind of oil or gas company that I can see compounding steadily over 10, 20 years. I think if I was to be interested, it would have to be some type of special situation kind of thing, or like extremely deep value type opportunity. But no, it's not too interesting to me.
Yeah, I will say getting like a 300 or 400% return on a huge position is not all it's cracked up to be, because I put money into Google, and or even you could say Prosus, and man, that was funny. It was funny, but I put money into.
I hate it when that happens.
I hate getting these 300, 400% returns.
It's not all it's cracked up to be, because I put money into Prosus, I put money into Google, and it's like, then I sleep at night and I don't have to like make a decision ever again, because unless those businesses get like absolutely egregiously overvalued, or I find something amazing I want to buy that I can pull from these piggy banks that they become, you don't really have to think about them. You just have to watch the business get better and better. But something like Pedevco and Ring, I did buy those because of net asset value, like discount to NAV. And they are, I think, like, especially like Ring, it's being well run right now. But at some point, like if oil goes to $200, then at some point I'm going to have to worry about like selling Ring, because then the price of Ring goes up even more. And I just find myself thinking about it a lot in terms of like, should I be selling? Is it time to sell? And Matt feels my pain out there. So. But there's a lot of like worrying that you're going to make a mistake when you sell. Like I've already sold a lot of Ring, and sometimes I think I sit back and I'm like, man, I could have 3 times what I have now in Ring. But then I bought other stuff. So a lot of work, a lot of hard work,
Yeah, I feel the same way investing in Kelly Partners at 91 cents. It's just hard, man. It's hard to accept those huge returns. Jason.
Well, it's
I
like,
feel
what do
your
you do
pain.
with it now?
At
You've
least
got
you
guys
can
like
hold that,
Tom
though.
chirping in your ear. It's a 40 PE. Should you sell? Blah, blah, blah. And you don't know what to do.
Yeah, at least it's not a crappy oil company, though.
Very true.
Yeah. And there are two ways people kind of look at oil. The way I've approached it that's worked for me is a net asset value way of looking at things and looking at the asset values. But I know there's a lot of other investors who look at it more like cash flow versus the price of the business and return on price based on that cash flow and those kind of things. But I'm kind of with you, Frank. Like at the end of the day, when you drill the reserves and turn them into cash, they are running out, and then you have to put money back into the business. So that return on investment cash flow story can only go on for so long without a bunch of reinvestment.
Yeah. Cool. Any
And
last questions, guys?
Well, I want to plug something. And that's the Investing with Tom podcast. You did another interview with Guy Spear. I started listening to it today, and Jeremy's going to comment about it. Tom, can I just pay you a compliment? Your interviews with Guy are like legendary. They're becoming legendary, and I hope it's like a recurring thing because they're really, really fun to watch. And not only that, I feel like I'm learning so much from those interviews. So thank you for setting that up and doing that.
Yeah, my pleasure. It's kind of weird to even be able to talk to Guy, to be honest. But
it is a little weird for me.
It's pretty cool
knowing you like kind of as a friend, and then seeing you talk to one of our heroes in that casual kind of way. It's very interesting.
Yeah, and I try to keep those interviews as casual as I can. I kind of just want to hear what's on his mind, I think. So hopefully it comes across like that.
Yeah.
Cool. Any last questions you guys want to take? Should we wrap it up?
All good.
Dead air. All right. It's been fun. We'll see you guys next week. Thanks, everyone.